Hi, Adam Gower here of GowerCrowd.com, and in today's podcast I'm going to be talking to Paul Fiorilla, who is Director of US Research at Yardi Matrix. Now, Paul is a regular here on the podcast, and recently I saw him pen an article, or a post, I should say, on LinkedIn that corrected some analysis that had been put out by Goldman Sachs regarding the recent banking crisis. So it is in large part that we're going to be talking about what's actually going on with banking as it applies to commercial real estate, the impact on commercial real estate today. To find out more about Paul, go to the podcast page at GowerCrowd.com. And of course, while you're there, do sign up for our weekly newsletter. It goes out every Wednesday and it covers the world of real estate crowdfunding and syndication in detail. It's completely free and you can always unsubscribe. All there at GowerCrowd.com. All right, so without further ado, here he is, Paul Fiorilla, Director of US Research at Yardi Matrix. Paul, super good to see you. Thanks so much for your accommodating the schedule today. Let's get straight into it. Just 5 days ago, you wrote an article on LinkedIn commenting about recent bank failures in a particular context. Why don't you tell us a bit more about what's going on with banking and reference that post on LinkedIn as well, if you would, please. In whatever context you want to.
Right. So I was sort of correcting the record about incorrect information that's been unfairly, what I believe, maligning the commercial real estate industry from people outside the industry. And right now, because of, the bank failures, there's been a lot of attention given to commercial real estate from people outside the industry that is not normal. I mean, I've been, writing research for decades, and there's an audience, a commercial real estate audience that I have and that read those kind of things. But right now, there's a lot of, attention from outside the industry, and, some of that notoriety is good, and then some of it is not, in the sense when they get things wrong. So as we all know, that SVB and Signature and, a couple other banks have failed and had issues for various reasons, stemming from the increase in interest rates, but also other things, crypto investments. And so that has prompted there to be a lot of discussion about the impact of the small and medium-sized banking sector on commercial lending.
Which is the sub 250 billion, isn't it?
If that's how that's one way to define it, right? So, there's a lot of banks of a lot of sizes. And I mean, I did a paper about banks years ago and trying to define, what's the number that constitutes small and medium? And that's an art, not a science, right? It's subjective. But anyway, the goal, Goldman put out a report on the banking industry, which discussed how big of a percentage that small and medium-sized banks have on particular industries. And there was a line in there that said that small and medium-sized banks account for 80% of commercial mortgages.
Right.
And when I saw that, I said, that doesn't sound right. I know that's not true. And as it turns out, what they were describing was that there's some FDIC data in which small and medium-sized banks account for 80% of bank commercial mortgages, not all commercial mortgages, which is a huge distinction, because banks as a share or have a much smaller share than that of all commercial lending. There's, depending on how you look at it, if you look at it by annual originations, small and medium-sized banks have originated anywhere between 13 and 24% of originations in a given year, going back to 2013. And large banks, kind of the large national banks, account for roughly 13 to 16% per year. Small and medium-sized banks share changes annually depending on how active other lenders are. The large banks share doesn't change as much because they're much more consistent in their approach to the market.
That's only 40%, isn't it, Paul? Who else is lending?
So,
yeah.
And if you look at total outstanding, what's held on book, the number banks, all commercial banks, hold anywhere between 38.6% if you use the Mortgage Bankers Association number, or about 50% if you use just basic Fed Reserve data and don't filter it. So, at the very least, small and medium-sized commercial banks probably account for any, 20 to 25, maybe at the high end in a given year, 30% of commercial mortgages in a given year. And because of the nature of their relationships and balance sheets, they tend to focus on construction and small, loans on small properties, sort of the middle market. So now, when this is all to get to the issue of how big of an impact are these bank failures going to have on the commercial real estate market? And like everything else, it's a nuanced question. So there are clearly small and medium-sized banks are cutting back as they assess the risk in their portfolios. I'm sure every bank that has a commercial real estate portfolio is doing a study, if they haven't done it already, saying, here's the risk, and here's what we think we should do going forward. Maybe let's cut back because the sector looks like it's going to go through some headwinds. So let's assume that there is a reduction in lending in that segment of the bank market. Clearly that's going to have an impact on the landscape. It'll particularly affect, as I said, construction going forward, and small to medium-sized properties. It doesn't affect as much kind of the institutional kind of lending world. So when we talk about the impact of this, it's definitely negative, but I also think it's important to say that it's nuanced, and that the impact is not broad-based across the entire market. Now, other lenders are also cutting back, right? We're at a time when the rise in interest rates have put pressure on banks in general. Plus, we're headed to a time when there are there's a lot of negative sentiment about the economy and demand for commercial properties. So if we were heading into a time when interest rates were going up because the economy was red hot, then banks might be willing to say, hey, you know what, we're bullish about the economy and demand for commercial real estate. We're not going to cut back because of the interest rate issue or the potential drop in values, because property values are going to keep going up because income is going to go up. But at the same time, right now we've got the interest rate volatility, and the 10-year Treasury just dropped to 3.27. Wow. So one of the things is that the mortgage rates went up so much, but now when the 10-year Treasury was at 4.5%, now it's at 3.25, 3.27. So that in some way diminishes the concerns about refinancing at high interest rates, not entirely. But again, there's a lot of nuance. So if banks are looking at this saying, I'm going to cut back because I'm worried about interest rates, but then this also kind of minimizes slightly the problem with refinancing at a higher interest rate. And that, we have the issue of loans coming due at a high interest rate environment loans that were originated in a low interest rate environment being, refinanced in a high interest rate environment. I looked at a few months ago, I wrote a piece where I I looked at it like a $7 million mortgage on a $10 million property. And
Right.
if you were to, if that was a 3% interest rate and you're refinancing it at 6%, and you were going to keep the monthly payments the same, then the property would, at 6%, would qualify for $4.9 million as opposed to $7 million. So, and you can see there's a huge gap that would need to be filled.
Yeah, it is huge. And that's really the big story, isn't it, Paul? That it's the refinancing, it's the ability for real estate that was purchased at incredibly high rates during a low interest rate period to handle an increased interest rate environment. And that's really what's putting pressure. And that's, I mean, you talk about the small and medium and this issue with the Goldman report not being necessarily accurate, but what's going on overall with commercial lending, because this story about refinancing is clearly not unique to small and medium-sized banks.
Yes, well, each type of lender, look, there's less debt availability now than there was. The GSEs, which of course have the implied backing of the federal government, are still relatively active in multifamily. So for multifamily, again, it's not 100% of what it used to be, and rates are higher than they were a year ago, but the GSEs are still functioning.
When you say it's lower, sorry to interrupt you, but when you say it's lower, is that because they don't want to lend as much, or because their lending standards have tightened, or because fewer borrowers are qualifying with the deals that they have, with the assets that they're bringing forward?
Yeah, I think it has mostly to do with lending standards tightening. I think in the run up to, a year ago, and the market had been in, had no downturns for a decade, and values were high, and property performance was strong for years on end. And I think not that standards were anywhere near as aggressive as they were leading up to the global financial crisis, but there's a natural tendency to to relax a little bit, edge up a little higher over time on LTVs, and a little bit more lenient on projecting future growth. So
I see.
And I think right now that all lenders that are lending are tightening their standards. The latest numbers, I think 70% of lenders, the survey said that 70% of lenders were tightening recently. So I think the vast majority of lenders are looking at everything a little more carefully, penciling the numbers. But it's better or worse, in some parts of the market. So small and medium-sized banks have cut back. Probably larger banks have been careful now for a while. CMBS is pretty much on the sidelines because the demand for the bonds is very weak.
That's a big part of the market, isn't it? CMBS.
Well, CMBS,
11% or so. I mean, it all adds up.
Yeah, I mean, CMBS has been 15 to 25% of the market, depending on what year you're talking about.
Yeah.
And right now, it's hard to function when there's no resale market. When there's investors are not willing to buy the bonds, then CMBS lenders can't originate loans.
Right.
Life companies, which are have long been a significant chunk of the commercial mortgage market, they're still lending. Again, they have the kind of the luxury of being able to take the best deals and the highest quality properties, and so they've done that. That's historically been their role, and they're still doing that. There's private equity has been increased their share of the market in recent years. CLOs in 2021 had record $45 billion of issuance. Like CMBS, that market has also kind of been impacted by, the lack of buyers on the bond side. So, there's the availability of debt has been, reduced. Now, there's also, the fact that transaction activity has declined pretty dramatically.
And that's because of this mismatch between,
right,
in price discovery, right? No,
right.
Sellers aren't yet letting loose.
Right,
They're hanging on while buyers are just recognizing that they can't afford the prices that.
Right, the increase in interest rates and going from, a 0 interest rate to a 5% interest rate, and going from, a 1.5% treasury rate to a 3-4% treasury rates, that has increased the cost of debt. And one of the impacts of that is to decrease the value of commercial properties. The question is how much, and that's gets to, the gap between buyers and sellers. Because, the different property types, and another nuance of this is different property types. You look at like multifamily. Multifamily has continued to perform really well. Industrial rents continue to perform really well. Office, on the other hand, nobody wants to touch. Very few people want to touch an office loan. Very few people are interested in buying an office building with all the uncertainty about future demand. So there's a huge bifurcation depending on the property type. And also, when you're talking about refinancing, to get back to what we started this conversation about, the difficulty of refinancing a low interest rate loan in a higher interest rate environment. It depends to some degree on when the original loan was written. So if you have a loan that was written 7-10 years ago coming due, you've had the benefit of income increases from the time you originated the loan, particularly multifamily. Multifamily rents nationally went up 22% in 2021 and 2022, according to Yardi's data. So if you had a multifamily loan originated 5 years ago, even if your rate is going up, you've got some cushion from the fact that your property performance is probably better now than it was when the first loan was originated. But if you're in a property type where rents have been flat or going down, then you don't have that benefit, and then you're going to be squeezed by the higher rates. Plus, if there were a lot of, even on multifamily, there were a lot of floating rate multifamily loans originated in, say, 2021,
right,
that are coming due, and they haven't had the benefit. They've had the benefit of a little bit of rent growth, but not as much as properties that were.
Well, actually, certainly not enough to compensate for a doubling in the cost of debt.
So all this to say, it's a very nuanced discussion that, depends on a whole host of factors, the market you're in, the type of property, the length of the loan that you're refinancing, the original maturity, or the original origination date. So my best guess, and what I've been saying is, there's definitely going to be an increase in default delinquencies. The question is how much, and I think for multifamily, there's a small window of loans, value add properties that were originated, loans on value add properties that were originated, 2-3 years ago, that haven't met their projections,
right?
And refinancing into a higher rate, that's the kind of property that will run into some kind of issues with refinancing. Not stable properties with 10-year mortgages that are being refinanced, or in markets that are really growing and still seeing strong rent growth. Office, some retail. On the other hand, there's a much smaller window for those, and they have a lot more problems both with performance and with the willingness and tolerance of lenders to lend in those segments.
Now, you've been in this a long time. I know a lot longer than it appears just from looking at you could possibly have been in the industry. You've not managed to acquire quite as many gray hairs as I have. But I have to ask you this, and I know it's that kind of question that no economist researcher likes to answer, but what is your prediction for how the commercial real estate industry is going to handle this over the next, let's say, before the end of the year and into 24?
Handle the bank?
Yeah, well, bank crisis, interest rates primarily. I mean, if we see more banks fail, that's a different industry altogether, isn't it, Paul?
Right.
But it does speaks to liquidity. Liquidity is shrinking because interest rates have gone up. But, buyer-seller expectations aren't matched. There's a lot going on. There's a lot of stress in the commercial real estate industry. How do you see this playing out?
Well, I think the industry largely, and again, it depends on the property type and the location and a lot of different things. But, sort of generalizing, I think the industry is going to have to hunker down and because unless somebody absolutely has to sell for some reason or another, either because of a maturity issue that they don't want to, they can't refinance, they can't put more equity into a property, and don't want to do a gap financing with a third party. If you have a sale as a result of a death or a change of ownership or something like that, if you have you absolutely have to sell, I think you'll wind up transacting. But for the the vast majority of owners, I think it's just a matter of trying managing your properties as best as you can. And a really important factor is to manage your expenses, right? Right now, even though the last few years in a lot of property sectors has been great growth in rents, income expenses have gone up almost as much in some areas. So property taxes have gone up, insurance is going up, particularly in places like Florida and Texas that have had a lot of storm-related issues. The recent tornadoes probably increase insurance rates in other parts of the country. So you've got increases in taxes, insurance, labor costs have gone up, energy costs have gone up. So I think it's important for property owners that they're just going to be holding on to properties to address the expense side of the equation. And there's a big, and then kind of hunker down until we get to the other side of this, which is another whole nother issue in and of itself. We're no doubt coming up to some sort of a downturn. Does it reach the level of a recession or hard landing, soft landing?
And what about anecdotally, Paul? What are you hearing from clients about the market? I can certainly share with you the sense that we get. We see a lot of sponsors talking about what they're seeing, both in terms of acquisitions, but also, I'll tell you, there's this kind of undercurrent of nervousness. I think a lot of sponsors, the sense that we get, are fighting a good fight to try and stay above water, putting on a brave face, but definitely struggling. That's not to say that it's the quality of the people that we see, of course. I think it's that industry in general. Are you seeing the same thing at Yardi?
Well, I mean, there's, there are parts of the market where you could say that, but I think you talk to people in the multifamily market. I talk to a lot of people in the self-storage market.
Right.
Those are sectors that have performed well. Occupancy rates have decreased in multifamily, but they're still strong by historical standards. So I think most operators, kind of feel that they have to, like I said, hunker down and kind of manage their balance sheets. But I don't think they're, pessimistic about being able to get through to the other side. Same thing with storage, right? Storage, we had the biggest growth in street rates in 21 and 22 that the industry has ever seen. Occupancy demand went high. A lot of it had to do, coming out of the pandemic. The pandemic actually was good for the storage industry in the sense that it created demand. A higher, the number of storage users increased. The percentage of households that use storage increased during those 2 years. And storage occupancy rates went to all-time highs. So now the street rates are kind of flattening out, but storage operators are raising rates of existing customers, and so that's where they're getting their income growth right now. And I think the sense is there's a lot of nervousness about, we're in good shape unless there's a hard landing, which would affect the whole economy. And if we have massive job losses, and if we have, reduction in demand for commercial properties as a result of that, then I think that causes, sort of more widespread pain for the industry. At the moment, because the job market continues to be strong, even though it's softening, but it's still, you look at the unemployment rate, the wage growth, the number of jobs available per unemployed person, still very high. So when you look at those kind of things, it doesn't look like a recession. It doesn't. I mean, we're definitely not in a recession now, but even with rising interest rates and the Fed trying to slow the economy down, it still looks more like a soft landing type downturn than a hard landing.
Paul,
so I think,
I'll go ahead.
Yeah,
sorry.
I'm just generally speaking, to finish the thought, most of the operators and most of the real estate people I talk to, still, they're worried, but they're still expect to get through it.
I should have asked you, as we wrap up, I want to ask you a couple of key questions here, but I should have asked it right at the very beginning, but I'll ask them now anyway. Can you kind of give me a high-level overview of what Yardi does, Yardi Matrix, and of course, what's your role over there? Because I know you have a very important position. But what do you guys do, and what do you do?
Right. So Yardi Systems, our corporation, is a leading provider of software for property owners, accounting software in the co-working market, the energy management market. We have many software products to help property owners manage their accounts. We have software that's now widely used in the funds management industry. And I'm with Yardi Matrix, which is the data arm of Yardi. We are a data provider with our main property types are in multifamily and self-storage, and we also have databases with single family rentals and student housing, and in the storage, RV boat storage. We also have databases in commercial sectors, in office, industrial, and retail that are part of our commercial edge unit. And I oversee research publications at Yardi. So we publish a wide variety of national and metro outlooks. We publish monthly rent updates in multifamily, storage, office, and industrial. And we publish, a lot of thought leadership pieces about market trends. So that's what I do.
Right. And you write these incredibly detailed and interesting reports, don't you? When's the next one coming out? What's it on?
I am working on a piece which talks a little bit about, which kind of looks at loan maturities over the next 3 years in different property sectors. And we're plotting the volume of loan maturities versus the the vacancy rate in the by metro, so you can see which metros have the most maturities and the highest vacancy rate, and vice versa. That's one thing I'm working on. I'm working on a piece, when I get the time on the single family rental sector. We just kind of updated our, total database on that, looking at the growth of that sector in single family rents and built to rent, single family rentals and built to rent segment.
When will the maturities report be ready, Paul? Do you figure?
I'm hoping to finish it as soon as I can. I've got a lot of other things to do. I mean, I don't talk about this in public, but I mean, I've got, I don't know. I'm just, it's part of my schedule, and I'm trying to finish it.
Well, it sounds like an especially interesting.
I'm also working on, we now do I don't know if you have any listeners in Canada, but I produce or I write our quarterly Canada multifamily outlook.
Oh, well, the maturities one sounds interesting because that really dovetails into what we're talking about today.
Yeah, no, it definitely is.
And you'll be able, and you're looking at different metros, so that's also interesting.
Yeah, we looked at maturities by office, industrial, and apartment, by metro, by year, and.
Well, I'm looking forward to that one. Definitely, I know I'm on your email list, but definitely send it to me if you would when you've got that, and I'll distribute that in our weekly newsletter as well. Paul, before we started today, we talked about the possibility of doing some snapshot, the kind of podcasts when big events occur, and I would really love to do that. For today, though, thank you so much for going through your insights regarding these bank failures and the impact on commercial real estate, and also for talking about that LinkedIn article. As soon as I get this podcast produced, I want to add it to the comments there on LinkedIn as well. And anyway, thanks so much for joining me today, Paul, as always.
Yeah, thanks for having me. Happy to do this again anytime.
Well, that was Paul Fiorilla, Director of US Research at Yardi Matrix, and we will definitely be hearing from Paul again. He is a font of all knowledge, being situated as he is at Yardi Matrix, where he has access to some incredible data resources. Paul, thanks so much for joining me today. It's always a pleasure to see you. Thanks for all your insights and for your time. And thank you as well, dear listeners. I really hope that you find these podcasts as interesting as I do and are able to derive some value from them. That is all from me today. I will see you next time. And for now, this is Adam Gower signing off.